Hi, I'm Andrew Mitchell. In this video, we're going to talk about vacant land being held by a non-CFC that turns out to be a PFIC, or a passive foreign investment company. In the last video, we talked about vacant land being held by a controlled foreign corporation, or a CFC, and in this video, we're going to discuss when a foreign corporation that's not a CFC owns foreign land. In our example, Betty is a U.S. citizen. Stan is a non-resident alien. Stan and Betty own foreign corporation, or FC. Stan owns 60%, Betty owns 40%. It's not controlled by Betty, so she's not controlled by U.S. persons, so it's not a controlled foreign corporation, or a CFC. Stan contributes $60 into FC, Betty contributes $40 into FC on January 1 of year 1. FC buys from a seller some foreign land for the $100 that was just contributed. So after the purchase, FC owns the land, seller has the $100. In years 2 through 4, nothing happens. There's no activity. And then in year 5, at the end of the year, a buyer comes along and buys the land from FC. So after the sale, FC has $120. FC has recognized a gain of $20. The proceeds were $120 and the basis was $100, so that gives a gain of $20. In year 6, FC liquidates, distributing its cash pro rata to its shareholders. $72 goes to Stan, that's 60%, and $48 goes to Betty, that's 40%. So the analysis in year 1, the land is considered a passive asset. FC is a PFIC with respect to Betty because FC's only asset is a passive asset, so more than 50% of FC's assets are passive assets. Betty makes no elections with respect to FC. In years 2 through 4, nothing happens, there's no activities. And then in year 5, FC had the gain of $20, and there's no impact to Betty in year 5 when FC sells the foreign land. Then in year 6, when the liquidation occurs, Betty gets cash of $48. It's a liquidating distribution under Section 331. Betty is treated as if she sold her shares in FC for the cash of $48. So she has proceeds of $48. She has a basis of $40, which is the cash she originally put in, so her gain is $8. So continuing the gain analysis, the $8 of gain is going to be an excess distribution under Section 1291A2 because FC was a PFIC with respect to Betty. The gain is going to be allocated to each day in Betty's holding period of the stock of FC, and a deferred tax amount is computed. The deferred tax amount is the tax for the applicable year at the highest ordinary income tax rate plus an interest charge. So here we've got years 1 through 6. Betty had a gain of $8 in total. So we're going to prorate that gain across all of the years. Since she sold it right at the beginning of year 6, virtually none of the gain is allocated to year 6. It's all just $160 is allocated to each year. The tax is taxed, again, at the highest rate, the highest ordinary rate of 37%. So it's 0.59 worth of tax for each of the years. And then there's an interest charge for each year. Now, the interest charge is intended to nullify any deferral benefit that Betty might have obtained. And so there's a larger interest charge for older years and a lesser interest charge for more recent years. So this is the total. Betty is going to owe tax of 2.95 plus an interest charge of 0.43 on this transaction. So what would happen if instead FC had not sold the land in year 5, but Betty had sold the shares of FC at a gain of $8 at the beginning of year 6? So again, in this case, Betty's not receiving liquidating distribution out of FC, but instead she's just selling the shares for $48. Her basis is $40, and she has a gain of $8 at the beginning of year 6. The result would be exactly the same. Betty would just have a gain of $8 that's treated as an excess distribution in year 6. So in this situation, Betty did not make any elections. And in the first column here, we've got the land sale in year 5 and the liquidation in year 6. And there was an excess distribution in year 6. That's a bad answer for Betty. And then under the alternate facts, there was no land sale, but there was a stock sale in year 6. That also was a bad situation for Betty. She's going to have an excess distribution taxed at our highest marginal rate plus an interest charge. So in the next video, we're going to talk about what if Betty had made a QEF election in year 1 to make FC a pedigreed QEF. And then in the video after that, we're going to talk about, well, what if Betty did not make a QEF election in year 1, but instead she made the QEF election in year 5, where the FC was a non-pedigreed QEF. And that's it for this video. I hope you enjoyed the video.